All right. I think I can kick it off. We have a good number of participants in the room already. So welcome everybody. My name is Yo Seal. I'm a researcher at the Lawrence Berkeley National Laboratory, and I have the pleasure to present today some of our recent research results. We just published a study that examines both modeled and empirical performance of solar and storage projects in the US wholesale electricity markets. And I'm excited to share our findings with you today. We had a great research team today. At this presentation is Julie Mulvaney-Kemp and Anna Shayed, but there were many others who contributed to this report. You can find the underlying briefing that we published and underlying data assets and the slide deck at our project website at emp.lbl.gov/utility-scale-storage. That link is also going to be in the bottom right on many of these slides if you forget it. And we will also post a recording of today's webinar there. Um, Before I continue, I first want to thank the US Department of Energy for supporting this work, and also our technical advisory committee with many great experts in this space who have steered our research, and of course, also many ISOs and utilities who contributed operational solar and storage data and thus enabled this research project in the first place. Um, So what are we going to talk about today? To provide you a little bit of background, as many of you probably know, solar generation at high penetration rates has a tendency to yield only reduced market value in wholesale electricity markets, at least when the electricity systems themselves do not have sufficient flexibility to absorb a lot of excess generation during the middle of the day. Our LBNL annual report series on utility scale solar has documented that over many years already. In California, for example, at a little bit more than 30% penetration rate of solar, the energy value of solar in wholesale electricity market has collapsed to less than 1 cent a kilowatt hour, and that is just way less than long-term generation cost. That is a problem for developers who try to bring new standalone solar to market. And so, in response to that, we see this increasing trend of coupling solar with storage to make the solar generation a little bit more nimble and flexible themselves. And it's great to see this rise of storage deployment across the country. But really understanding how these systems are operated and what the value proposition to the wholesale market or bulk power system is quite complex. But it is important both for private investment considerations and obtaining financing, of course, but also for overall long-term system planning. A key challenge here is that there is insufficient really data, operational data. A lot is proprietary and not publicly accessible, and so that's a challenge. Lawrence Berkeley National Lab has studied this effort now. We kicked off a 3-year study cycle on that. Today we're presenting the first year study results for the operation of solar and storage between 2020 and the end of 2024. We will update that 2 more times to include also operations in 2025 and 2026, and they're currently collecting data for that purpose. We will also have some other standalone studies, one looking in more detail at resource adequacy contributions of solar plus storage, and another one looking at broader bulk power system impacts. But today we just present our first year results, and the primary objectives are to quantify the wholesale market value of these PV plus storage projects relative to standalone PV. And we do that and we develop a couple of scenarios, one of which includes perfect foresight of prices and generation. So kind of an idealized revenue stream. Then we want to compare this idealized revenue stream with generation costs. And finally, compare our modeled operational data with empirical operational data for several ISOs and balancing authorities for which we got that data. Using then this comparison, we want to identify barriers that prevent these projects from really realizing their full potential, contributing the most as possible to the bulk power system, while also increasing returns for private owners. We have about 45 minutes to go through this presentation today. I would recommend that if you have any questions, if things are unclear, please submit a question through the Q&A box. We'll have a little bit of time towards the end to answer those live and try to tackle others during the presentation already. To start off, I want to describe our sample a little bit more. So we examined 280 PV plus storage projects that were operational at the end of 2024, and that was roughly 95% of the entire fleet in the United States at that point. We're only focusing on large-scale installations that are larger than 1 megawatt, and defined for this purpose really co-located PV as a very broad bucket term. As long as you have PV, large-scale PV and storage behind a common point of interconnection, we included here in the study. It's important to know, though, that not all of these projects are actually active participants in wholesale markets. Some are, even though they are large in size, are primarily operated for state incentive programs, for example, or have other private off-taker for the electricity. And then, of course, there are some projects that are just outside of organized wholesale markets. As you can see in the bottom, we have the 7 large ISO regions in the United States, but then also 19 additional balancing authorities, and especially in the Southeast, we lack organized markets there. Then in terms of the regions that we're covering, you can see here on this graph in yellow, the PV capacity that is included in our sample, and in blue, the storage capacity. California, CAISO stands out with the most capacity, followed by ERCOT, and then a couple other non-ISO balancing authorities in the west and the southeast. Overall, the market has been extremely dynamic. In the top left, you see the cumulative capacity over time by region for PV on the left and storage on the right. And again, you can see the big role that California and Texas and the non-ISO West play here. And what you can see really that the market has just really kicked off in earnest over the last 3 years. So this is a perfect time to take a look at the initial operations of these projects over the first 3 years or so of their lifetime and glean some initial insights into how they are operated. In the bottom right, we have a couple of statistical comparisons of various metrics, how to think about storage size relative to the PV capacity. This is really important because the technical design of the battery relative to the PV is important later on when we think about what these storage assets can do for solar to boost solar value. We have in yellow the storage to PV capacity ratio. In California, for example, about maybe 60% of an average PV capacity would be coupled with storage. And then the storage duration at full rated storage capacity in California would be about 3.5 hours. And then if you multiply these two numbers together, you get what we call the PV equivalent duration. It's just a handy little shorthand. In California, this means that a battery on average would supply energy for 2.5 hours at like full rated PV capacity. In reality, they cannot do that because of like storage capacity limitations, but it's just a nice little shorthand. And we have indications of this PV equivalent duration on many of our slides when we talk about differences in technological designs between markets. And with that, I want to hand it over to Julie to take us through our methods.
Thanks, Yo. So for all of these projects that Yo just mentioned, like what are we doing with them? What are we analyzing? A key metric is what we're going to call the wholesale electricity market value. This is a value that crosses three value streams: the energy value, the capacity value, and the ancillary services value. We look at this for the PV combined PV plus storage project across all value streams, and as well as a point of comparison for the PV standalone, which is not a real project. It's kind of a hypothetical plant if you only had the PV component of this co-located project. And for those that kind of configuration, we only look at the energy and capacity value, as those type of projects are typically not eligible to offer ancillary services. What does this value represent? You can think of it as being the short-term procurement cost that an off-taker would avoid by purchasing output from this PV plus storage project rather than from wholesale markets. I want to be clear that this isn't an estimate of actual project revenues. That really depends on contract terms for agreements that these projects have signed and additional value streams that we're not including here. For example, renewable energy credits or avoided transmission or distribution costs. All of the results we're going to talk about are for this base case scenario. If you're interested in some other sensitivities, we have a number of those in the full report online to kind of quickly tick through what the base case covers. It's focused on day ahead markets in the ISOs and RTOs. Outside of that, in other balancing authorities, we use energy imbalance markets or FERC system lambda data to indicate energy prices. For ancillary services, we consider both regulation and reserve products. And there's always a kind of important question about grid charging and whether or not the batteries in these cases, when they're paired with the solar, only charge from that generator or whether they also charge from the grid. And we make that decision on a project basis when modeling these projects based on whether or not they are to get the investment tax credit, they would need to charge only from the solar that is coupled with it. Next. For each of the value streams, let's talk through the ways in which storage coupling impacts the market value. The difference between the combined PV plus storage value and the standalone PV value is what we'll refer to, and you'll see in the results, as the storage premium. That's that incremental value of that the storage provides to the project. Focusing first on the energy value. Energy value can increase when solar output is shifted by the battery into higher priced hours, or when the battery is performing energy arbitrage through charging and discharging from the grid. In terms of the total energy delivered by the system, the impact of storage can be mixed. In general, the energy delivered is less than standalone PV because of battery efficiency losses, but there are also cases when it can be greater. For example, DC coupled batteries can capture clipped energy, or when storage reduces curtailment. So it's not kind of a clear-cut story in terms of the energy delivered. Moving on to capacity value, PV plus storage projects typically receive a higher capacity credit, reflecting the added reliability contributions of storage. And lastly, as I mentioned, for ancillary service value, this is something that's only available to PV plus storage projects, not to this potential standalone PV. And so that creates a value premium. Next. The next three slides, I'll define our methods for calculating each of these value streams. Let's start with the energy value. As you can read in this equation here, it's a pretty straightforward calculation, but our energy value is the kind of sum of, at an hourly basis, the delivered energy, so post-curtailment PV, or for the combined project, the post-curtailment PV plus the storage dispatch times the energy price in that hour. And then we normalize on the bottom by the pre-curtailment solar generation. We'll do this on all of the different values so that we can compare between projects of different sizes. Key data inputs here are the energy prices. And for the ISOs, we're using the hourly locational marginal prices at the nearest node. In other BAs, we use either imbalance market prices or what's known as system lambda data as reported to FERC that approximates marginal operating costs. I want to just call out one thing about curtailment and how it impacts this metric in our kind of optimal dispatch approach. Solar generation is assumed to have zero marginal cost, and therefore we curtail it during negative price periods. In practice, real world marginal cost might be less than zero if there's production tax credit incentives or PPA terms that create a value there or renewable portfolio standard obligations. And so in practice, there may be less curtailment than what we would expect ourselves based on the zero marginal cost assumption. Next. Now we're going to talk about the capacity value. To calculate that, we take the project's capacity credit as a percentage multiplied by its nameplate capacity times the capacity price and sum that over the different relevant periods. And those periods might be by month or by season, depending on the region. How do we determine what the capacity credit of the resource is? We use the published accreditation rules in the ISO and RTO markets outside of ERCOT, where there's no explicit capacity value. And in non-ISO balancing authorities, we focus on the top 100 net load hours for the past 3 years, and we look at how much contribution the project provided during those key hours. The next input here is the capacity prices. And here we use either the zonal capacity market prices or bilateral proxies for those prices. I'm not going to go into detail here about these bilateral prices, but feel free to put something in the Q&A if you'd like to kind of come back to that later, or you can look at the report. Next. When we calculate the ancillary services value, we include both award value, which is the first term in the sum here, and a deployment value for each of the ancillary services. The award is based on the just the price for that ancillary service and the awarded capacity, whereas the deployment is based on real-time energy prices and how much of the award is deployed. There's a lot of details that we went into here. Next. These details and kind of assumptions vary both on the type of the award, whether it's a regulation award or a non-regulation award, and the specific market. I don't have time to go into all of these details here, but they are included in the paper. And again, we can come back if those details are of particular interest to someone in the audience. The energy ancillary service, and in some cases, the capacity values that I just defined, all depend on the project operation. On this slide and the next one, I'm going to cover how we model the project dispatch. So for a PV plus storage project, we take the modeling perspective of an asset owner who's a price taker and has perfect foresight into their generation and price conditions. They're seeking to maximize their market value while considering battery degradation. This is kind of an idealized scenario that helps provide one kind of reference point. We implement this perspective through a linear optimization model. This model has kind of key constraints that are listed here and considers costs, both the generation cost, which we assume is, as I mentioned earlier, is zero, but also a storage degradation penalty cost to approximate the toll on the battery of cycling. Lastly, this is really project specific. Each project is modeled based on its design characteristics, not a generalized profile. Next. A critical input to that dispatch model is the solar generation profile for each project. As you could imagine, if you don't know how much power is being produced and when, you're not going to have a very accurate value estimate. And these data are not generally publicly available at the project level. So we produced generation profiles that are both specific to project location and design characteristics and that are calibrated to observe data. The two-step process that's laid out here starts with modeled estimates based on the system advisory model. Then we debias or adjust, calibrate those modeled profiles using observed data at different resolutions. So we adjust for ISO reported total hourly generation, plant level annual generation, as well as curtailment reports. Next. So far, I've kind of talked your ear off about value. Before we dive into the results, we also need to cover our methods on the cost side of things, specifically our estimation of the levelized cost of energy, or LCOE. Our methods use NLR's annual technology baseline methods to get a lifetime cost per megawatt hour. We do this in two ways, one with and one without federal tax credits. Those tax credits include energy community adders where applicable, but not domestic content adders, and exclude production tax credit or state incentives. The approach varies both based on project level data, specifically the main difference being the CapEx cost and the capacity factor. And they also vary based on the date the project was built. That's this cohort level variation. We use time varying OpEx assumptions, design life, inflation, etc. And so that's kind of the main method there. One thing I want to call out is that with this method, retrofitted PV plus storage projects, those are PV projects where the storage was added later, they tend to have higher average LCOEs because their PV components were built earlier on when costs were higher. I think that that covers all of the methods that you need to know to kind of understand our results. So let's dive into those results.
Thanks, Julie, for that introduction. I've seen already many questions come in through the Q&A box. We're trying to answer them live as well as we can, but please keep them coming. All right, so now what did we find in our study? Let's get to results. First, I wanted to linger before getting in actual like value streams and revenues. I wanted to linger a little bit on the issue of capacity accreditation. Julie provided kind of like the method feedback where we follow the official ISO rules. And then in the non-ISO balancing authorities, we use this proxy of the top 100 net load hours and assess what the contribution of PV plus storage may be. This graph over here shows now the standalone PV capacity credit on the left in pale colors and the combined PV plus storage capacity credit on the right side in the darker colors by region and over time. And you can see overall that batteries significantly increase the firm capacity contributions on a national average in 2024 from about 20% to 60% of POI nameplate capacity. It varies, of course, quite a bit by region. You can see in 2024, according to other ISO rules, solar standalone had nearly no capacity credit, but it jumped to more than 50% once you add storage. There are some regions, for example, SPP, where we have like more than 100% of solar PV nameplate capacity, and that's just because the batteries there are really large and even larger than the solar capacity. So that just as a little bit of background, because like these are going to be the factors once we multiply them by capacity prices that will inform our capacity value. So let's have a look at what the hypothetical bulk power system value of these projects would be if projects would be operated with perfect price and generation foresight. On the left, we have again on the left side the standalone solar value, and then on the right side the combined PV plus storage value. And we have our different energy capacity and then ancillary service value streams shown here. First, you can see that both standalone PV and PV plus storage has an overall value decline between the early years 2021 and 2024. That's just driven by lower overall wholesale electricity prices and also lower ancillary service prices, especially in CAISO and in ERCOT. We see when we compare now, for example, for the year 2024, the value premium due to the addition of storage, that overall it increases from about $35 a megawatt hour for standalone PV to $75 for the combined solar plus storage, so by a factor of more than 2.5. That is really driven by the increase in capacity value that shows up here. On the right side, we just have the storage premium, which is basically the difference between the PV standalone and the combined solar plus storage bar on the right. And you can see that overall the contribution changes in early years. It was dominated by ancillary service revenue, and now it is dominated a little bit more by capacity revenue as the market kind of like deployment across the country with different market rules has changed. Now looking at regional results, we see that the overall value varies quite a bit. On the one hand, again, by project design and the battery size that is often coupled, but then also regional market dynamics, and especially in regions where we have high solar penetrations, like in California, the solar standalone value is rather low, and then the value premium that you can get by adding batteries is overall rather great. There are some regions where with increasing battery penetrations, we also see value cannibalization effects, especially here in ERCOT, where the batteries are overall still rather small and used to be focused on ancillary services. That ancillary service value has just eroded a little bit. And then, of course, in the non-ISO regions, we don't have any ancillary service revenue at all. But interestingly, there are still a couple of regions, for example, PJM or SPP, and to some extent ICE New England, where there is still not a whole lot of participation by batteries in these ancillary service markets. And so there are still potential revenue opportunities. Important to note, again, we only have a price taker model. Once you would see significant storage deployment over there and participation, those prices will likely come down over time as well. All right, so we've now identified that storage could increase the wholesale market value of solar a lot, but how does that compare to generation costs? In general, the idea is that if the levelized market value exceeds the long-term generation cost, then the solar plus storage is really a cost-effective tool to provide bulk power system services and increase overall welfare. Right, the exact question how that welfare gain is then distributed between project owner and off-taker will depend a lot on contract structures, and we're not going into that. We're just quantifying the difference here. And of course, if we find extremely positive net values, that would likely trigger new market entrants, and then the long-term equilibrium cost and value would likely converge as margins would likely get depressed. To do this comparison between generation cost and values, we condense the value streams between 2020 and 2024 into a single levelized number. important here to note is that we do not forecast any future revenue, right? We're still at the very beginning of these asset lifetimes, and future revenue may be like uh, different from past revenue. That is not considered here. We're also excluding a couple of projects, those that have been operational way before our analysis period of 2020, and small projects for which we didn't have good cost data. General, we again leverage this really unique cost data set that we get under an NDA from EIA, and we have cost estimates for about half of the operating solar and storage fleet. And so let's dive in and see what we find. Here on the left side, we have the levelized value by cohort, so the various commercial operation dates. Again, we see this slight decline in value. Older projects in 2021 benefited still from like these high electricity prices, whereas newer projects don't benefit, they weren't able to capture those because they weren't around yet. Um, and so we take these values here, this gray line, it's the same as over here on this right side. That is the idealized wholesale market value based on perfect foresight. And now we compare it to the generation costs. And generation cost, we have both on the national average here with tax credits in yellow or without tax credit. And what's interesting is that we can show here that if you would operate these projects in an ideal manner, the net value is above generation costs. So these really would provide a significant overall bulk power value. 2020 here had a little spike. Don't need to be worried too much about that. It was just a lot of small scale installations, especially in the Northeast. Now, how does this net value vary by region? We do our analysis. Previously, I just showed you the national averages. Let's look a little bit more now on project level variation. Overall, we find that with tax credits, about 83% of projects for that recently came online had a positive net value, and even more than half, even without the tax credit, would be able to achieve a positive net value. Couple of high-level takeaways. In CAISO and ERCOT, two established markets, we see overall positive net value. So each of these little dots represents a single project, and we differentiate by the battery size, the project type, whether or not it's greenfield or retrofit, and then over year as well. So these are highly net positive. On the y-axis over here, by the way, is the market value, and then on the x-axis at the bottom is the generation cost. So you kind of want to be on the upper side of this diagonal line in order to have a net positive net value. Some regions like New York ISO or ISO New England have more projects that are below the diagonal, meaning the generation costs are higher, primarily driven by less solar resource up there, which then increases the overall generation cost. So for these two regions, the bulk power value would not be sufficient to offset generation costs. Many of these projects, though, have additional revenue streams from RECs or bilateral tolling agreements or state incentive programs, that may be used to underwrite these projects. And with that, I want to hand it over to Anna, who will now tell us a little bit more about like how these projects actually operate in practice.
Great, thanks, Yo. So yeah, I'm going to be talking about the comparisons of our optimized value with the empirical dispatch data. Next slide. So we used NDAs and some other publicly available sources, such as from ERCOT and FERC EQR, in order to gain an empirical sample of 51 projects in 7 regions that were built through 2023. Next slide. This slide is sort of the headline for everything that I'm going to talk about in this section. So when we're comparing empirical revenues with the revenues from optimized dispatch, real plants earned 62% of what perfect optimized dispatch would have captured in 2024. And there are sort of three main drivers of this lower realized value, and I'll return to each of these later in the section. The first one is a reduced ability for storage in practice to cash in on diurnal price arbitrage and kind of large price swings throughout the day. The second one is reduced ancillary services revenues, mostly stemming from under participation in ancillary services markets. And the last one is lower capacity market revenues, which in some regions, this might be due to data availability issues rather than true lost value. There's pretty significant variation by region, as you can see in this plot on the right. This chart is breaking down the value into three pieces with energy in blue, capacity in red, and ancillary services in green. And for each region, you'll see two bars. The sort of left hatched bar is what projects actually earned in our data. And the solid bar is the optimized value potential. And the gap between them is the value left behind. And the colors tell you which revenue stream came up short. In ISO New England, New York ISO, and in ERCOT, the biggest shortfalls are coming from ancillary services. And in CAISO and the West, it's more about capacity and energy. And we'll unpack some of these in the slides that follow. Next slide. All right, so here we're showing the results from comparing the optimized and empirical market value for a single project in a utility in the West. On this plot here, the upper plot on the right, the left panel shows the solar value in 2024. The middle is showing the combined solar plus storage value, and the right panel shows the storage premium, or the value that storage adds above the solar standalone value. The hash bars on the left side of each panel show the empirical value from energy and capacity, and the non-hash bars on the right show the optimized energy and capacity. In this plot in the middle facet, we can see that the empirical solar plus storage plant earned about $33 per megawatt from energy and capacity in its first full year in operation, with about 2/3 coming from energy and the other third coming from capacity. In contrast, the optimized plant earns about $61 per megawatt in 2024, earning about 2.5 times the revenue from the capacity market and about 50% more in the energy market. Some reasons for this huge increase in optimized capacity value could be due to the way that we evaluate capacity accreditation in non-ISO regions, which is evaluated based on the dispatch during top 100 net load hours. And the utility might have kind of other priorities for dispatching this project. And on the next slide, I'll show a deeper dive into some of the reasons that the realized empirical energy market value might not live up to the optimized potential. Next slide. All right, so this slide answers the question of why do these empirical energy values fall short, with two examples from actual data. We have negative prices on the left, and we have daily volatility on the right. And there's sort of a similar story both times, which is that the optimizer is reacting to prices effectively and quickly, while the real plant doesn't do as well. So on the left, the driver is negative prices. The top panel is showing real-time prices, and when it's shaded in pink, that's where the price went negative. So in these negative price hours, you actually have to pay to put power on the grid. So if you're behaving optimally, you would want to stop producing by curtailing solar generation and charge your battery during these hours so you can charge for free. The middle panel on this left slide compares the net output, so the combined solar and storage output from the optimizer in green with the actual behavior in red. And you can see that the optimized behavior has the plant charging heavily during the negatively priced hours, which are again the pink hours on the top, and dispatching during the positively priced hours. It's also curtailing solar generation, which you can see on the bottom is the curtailment. So its net output is negative, whereas the actual plant doesn't curtail its solar generation during those hours. On the right set of plots here, the driver we're looking at is daily price volatility. So in the top panel, we're showing the real-time prices on a couple of days when there were pretty significant price spreads. And on the bottom, we're showing the storage dispatch on these same days with empirical again in red and optimized again in green. The optimizer has perfect price foresight, so it charges when prices go low and discharges when prices go high. Empirically, we rarely see batteries moving with as much volatility as the optimized battery is doing here in green. And you can see in this bottom left plot sort of typical diurnal shape of the real battery shown in red, where it's able to capture some of the real-time price differences in its sort of single charge discharge cycle throughout the day, but not as much as the optimizer, which charges and discharges several times throughout the day. Next slide. Okay, now we're going to zoom in on ERCOT. ERCOT has one of the largest battery fleets in the country, and they make their operational data public, so there was no NDA required here. Well, they have a really large battery fleet. Only a small portion of these are co-located with solar. So our sample here includes 7 projects that came online through 2023. The batteries in ERCOT are also small relative to their paired solar, with an average PV equivalent duration of just 0.3 hours in 2024. In 2024, we're finding that the storage premium for adding storage was $4 per megawatt empirically, but the optimizer gains $9 from adding storage. So projects captured only about 44% of their optimized potential of adding storage. The chart here is comparing standalone solar value, the combined solar plus storage value, and the storage premium. But the cleanest way to look at this might be to look at the table at the bottom, where we find total solar plus storage value of $27 empirically versus $34 optimized per megawatt hour. And when you decompose the storage premium, almost the entire gap comes from ancillary services. There's $3 captured empirically versus $8 possible. Whereas the energy value is essentially fully captured by the empirical plant. So the ERCOT shortfall is fundamentally an ancillary services story. And we don't have a slide here, but we found that empirical plants are less price sensitive than the optimized plants. They generally sort of bid into the same ancillary service product markets day after day, rather than switching around to capture the highest prices like the optimizer does. Next slide. All right, we don't have time to do a deep dive into all of the regions where we have empirical data, but this slide sort of summarizes our results across all of the regions where we do have data. Here we show one unifying metric, which compares the empirical storage premium with the optimized storage premium. And a score of 100% would mean that the empirical plant captured all of the storage premium that the optimizer did, while a score of 0 means that it would capture none of it. Across all plants in 2024, the average performance score was 37%, but there's kind of a wide regional distribution ranging from actually negative values, negative 31%, all the way up to 66%. And across plants, the performance score is kind of mostly steady between 2021 to 2024. Next slide. And then lastly, here we're sort of putting everything together by comparing the levelized costs with the optimized and empirical value. Our CapEx sample significantly reduces our empirical sample down to just 25 plants. And you can see the region level sample on each plot facet. So just keep in mind the small sample size when interpreting these results. And also keep in mind that the LCOE metric that we're comparing value with is sort of projecting value into the future. Well, in reality, the future is very uncertain. So don't take this as sort of the be-all, end-all of whether or not solar plus storage plants are profitable. And lastly, the market value here doesn't include state incentives like RECs. Okay. Now that I've gotten all the caveats out of the way, let's look at what we're finding. So despite all of the operational shortfalls of our empirical solar and storage plants, on average, their net value is still $8 per megawatt hour, higher than levelized costs from 2020 to 2024 when including the investment tax credit. In this chart, the red bar shows the levelized costs of each solar and storage plants, including tax incentive. The solid gray bar shows the optimized market value, and the hash gray bar shows the empirical market value. If the gray bars are above the red bars, it means that the projects earn more than levelized costs, and vice versa. In ERCOT and in the non-ISO West, empirical market value exceeded levelized costs. This is also where solar and storage deployment has been strongest. In ISO New England, projects could have exceeded costs under optimized operations, but in reality, they earned far less than the LCOE. And in our small samples in New York ISO and MISO, neither the optimized or empirical projects earn more than costs. And in the revenue reported to FERC EQR and CAISO, these plants earned about the same as their levelized costs. All right, that is going to conclude my section, and I'll hand it back to Yo to wrap things up.
Awesome. Thanks, Anna. We've had a lot of questions already, and I think we've answered like nearly all of them, 23 or so already. If you have additional ones, please feel free to put them into the Q&A box, and we can touch on those remaining questions then in a moment. But first, to wrap up today's presentation, so we've shown that solar plus storage projects and their idealized operations can have a significant value boost to solar, exceeding the underlying generation costs by a significant margin, at least on average across the nation. But that in practice, not all projects are able to match this idealized operation with perfect generation and price foresight. And I want to dive a little deeper. Anna already gave us a lot of examples how that manifests in different regions, but kind of zooming out a little bit, what does that mean and what are the drivers of just reaching about like 40% of the storage value premium under empirical conditions? Well, there are some modeling artifacts, which is just, issues here of our studies that are not really manifesting in the real world. On the one hand, there's a lot of project level variation that a study like this that has national scope across hundreds of projects just cannot really mirror well. We use as much technical specific design data from EIA for each project as possible, but we don't have real world like cycling cost or warranty limitations or round trip efficiencies or really very specific POI limits. But just assume kind of broad averages here for our study. Similarly, there was a question earlier in the chat about ancillary service deployment. We model this as a constant scalar of about 30% of the award for regulation products and then 2% for other ancillary services. Whereas in reality, those deployment factors vary a lot, both between regions and then also within a region over time and over the course of the day. And these broad deployment factors are just coarse averages. Um, there is some unclarity about grid charging capability, especially when it comes to DC connected projects. We assume that every project that is in theory eligible for the storage standalone ITC would also engage in grid charging, but whether or not that happens truly in practice is a little unclear. And then, of course, there are some market design issues, like in the non-ISO regions, we have a certain uniform concept of resource adequacy contributions looking at these top 100 net load hours, whereas utilities themselves may look at this issue a little differently. We're going to dive deeper into this in a standalone study that is currently underway, and we'll be excited to share more results on that soon. And then on the other hand, we just are dealing with empirical data, and empirical data by its nature is messy. So sometimes the data series are incomplete, which is then not fully aligned with our optimized data. We try to adjust for that as much as possible when portraying results. Another issue is that we use solar model generation profiles, but the empirical solar generation profiles at times vary from that, and that has then cascading effects on storage operations and storage valuation. And then finally, for some regions like CAISO, we're relying at the moment on FERC EQR data. That only reports revenue for the combined solar and storage component of a project and does not really give us separate dispatch profiles for each component, which would really be needed to evaluate well the empirical storage value premium. So that's just a limitation of that particular data source. Okay, but apart from these more technical issues, zooming out, what really explains why some projects are not getting as much value as they in theory could? We have listed here a couple of operational and organizational barriers. And addressing these could increase the overall value that these solar plus storage projects that are now built in mass could offer to the bulk power system. In some regions, we simply don't have real engagement of these projects with wholesale markets, especially still in ancillary services, right? In nice New England, there are some projects that are operational, but not that many. PJM barely has any, and New York ISO also very, very little. So just not really engaging with the market is, of course, a first barrier. And then even when projects engage with wholesale markets, sometimes their dispatch strategies are really tied to out-of-market considerations, fixed delivery obligations under tolling agreements of PPAs. Then you have like these rack markets with certain volume obligations or state incentive programs. Really a big issue in Massachusetts, for example, with the Massachusetts SMART program. But we see a lot of these state incentive programs now being rolled out to incentivize the more storage deployment. And so alignment between those state incentive programs and the bulk power system needs is a core issue for the future. There are a couple of other things here listed about just insufficient responsiveness to price signals, maybe because the operator does not engage deeply with the hourly prices, but just has broad operational kind of rule of thumbs, charging during the middle of the day and discharging in the evening, irrespective of what is actually happening with prices, or not responding to negative prices, maybe because the contract is settled at a hub and not at nodal prices. And then, of course, the broader issue of imperfect price and generation forecasting, forecast errors. I think this is like one area where we're most optimistic about as this industry grows and the third-party operators become increasingly specialized. New machine learning algorithms are being deployed. Hopefully, that will those forecast errors will will shrink over time a little bit. But there's just inherent volatility, and it is difficult to really precisely predict market dynamics. And then finally, in the non-ISO regions, there is increasingly now, of course, with the energy imbalance markets moving to like full day ahead markets, more organized structure coming. But at least so far with the imbalance markets, we see some utilities still prioritizing balancing within their own BA and not fully following those energy imbalance price signals, or just in the Southeast where we have to rely on this FERC system lambda data. It's just not a good real proxy for true nodal congestion and price volatility, and thus doesn't really adequately capture the hypothetical value that these systems could provide to the bulk power system there if they just had better price signals. Okay, and with that, I think we're gonna conclude. I thank you very much for your attention. We were only able to cover about half of the content that is included in the total report. So I encourage you to go to our website at emp.lbl.gov/utility scale storage to download the full slide set. There will be a recording of the webinar from today. And there are also additional data assets. Somebody had asked, we are publishing, for example, all the project level optimized dispatch profiles on our website. So if you're interested in that, please go there. I thank you a lot for your attention today. And we have a few more minutes. Juliana, is there any question that is currently open that you'd like to answer live here?
Well, Yo, you might have a good answer to this question about LCOE. It says, do you think LCOE, or like, how do you think about LCOE as the standard metric to measure economic feasibility of a solar project?
Yeah, thanks. So we're like in practice, right? There's a lot of variation in terms of like the financing terms, cost of equity and debt, and like debt payment obligations. We are not capturing all that project level variation because we're lacking data transparency here. So we have some broad system wide averages across like the nation that we apply. We do vary project LCOE with project specific capex and project specific capacity factors or generation performance data. But in reality, you probably want to do like internal rate of return analyses, and of course, then like look at expected revenue opportunities over multiple years in the future. Of course, that future is highly uncertain, and for that reason, in our analysis, we only looked at historical empirical prices. But we're not claiming here to do a full profitability study of each of these projects. Just also because we don't have good data on all the bilateral contracting agreements and tolling agreements and associated revenues. Yeah, big caveat. Okay, I think we are at the top of the hour. I see there's one more question about how this all can inform decision making and planning for new PV standalone and PV plus storage projects. Yeah, as I said, this is all retrospective, right? The future will be different, and future revenue and opportunities and values will be different from past ones. But I think some of the like broad underlying trends are still useful for people to consider, right? Like declining standalone solar value at increasing penetration rates. And then the growing attractiveness of storage. We see in ERCOT and to some extent in CAISO as well, the crashing of ancillary service prices at increasing battery deployments, and then like more of a shift towards energy arbitrage, and growing battery sizes as well, right? So you definitely want to like think about those factors as you design your new project and really think how the overall electricity system is changing over the lifetime of your asset. Okay, well, thank you very much for your time. It's the top of the hour, and we look forward to hearing from you. If you have any further questions, feel free to reach out to either Julie or me. Our emails are here on the slide as well. Thanks so much.